Okay. So I'll just go ahead and go over a few housekeeping things. For those of you that I haven't met, that I haven't met. I'm Maria Valeri, the Pro Bono Recruitment Coordinator for the Volunteer Lawyers Project. Want to thank you for joining us today. By doing so, you've agreed to represent a pro bono client in the coming year with a federal income tax issue. So thank you very much. Want you to know we don't refer cases out automatically. You will be contacted to make sure you can run a conflict check and that the timing is right for you and whatnot before a file actually gets referred. You will be covered with our malpractice insurance and also earn 2 hours of CLE credit for every hour of legal services that you perform on the case. I did email everybody today the materials, the PowerPoint slides and some other handouts, and separately a verification of attendance. Because we can't do these live right now, we have to have 2 forms of verification. One is that I see you here today, and the other is that you return that verification to me after the CLE. You will have to fill in some codes, and those codes will be provided today during the presentation. So just pay attention, jot them down on that form. You can sign it online and email it back to me when we're done. For questions today, we're a small group. Please just feel free to type them into the question or the chat box, and we'll get to them as we go along. We'll be pausing, intermittently to deal with the questions that are there. And then what else did I want to tell you? Oh, at the end of the program, please stay to the end. When you sign up a Zoom, an evaluation form will automatically load. It's anonymous, so please just evaluate the program quickly. It's just check boxes and submit that. That would be wonderful. And then finally, we are recording today for on-demand purposes later on. And know that everything you type into the chat box, including the private chats, ends up getting recorded. So just so you're aware of that. So thank you again for joining us today. And I'm going to turn things over to our low-income taxpayer clinic attorney, Zara Salih.
Hi, everyone. Thank you so much for joining us today. So my name is Zara Saleh. I'm the qualified tax expert, the staff attorney at the Low Income Taxpayer Clinic with the Volunteer Lawyers Project. So just a little bit about my role. What I do is I represent taxpayers, low-income taxpayers with controversies with the IRS. And as I get cases, the ones that seem suitable to be referred out, depending on our volunteers' preferences, also usually will go through me. And it is my absolute pleasure to introduce our 2 wonderful speakers, Mr. Michael Tedesco and Mr. Derek Wheeler from Andriozzi Bluestein. They have truly been very gracious and wonderful with their time and support of our tax clients and VLP in general, and we are very grateful to have them today. And we're grateful that they were able to join us and provide share their expertise, really, because they really are the experts in this area, and I'm very grateful that we could have them. With that, I'm going to pass the baton to Mike.
Thanks, Zara. Just real quick before we get into the presentation itself, because my understanding is everybody who's on this is going to, at some point in the relatively near future, start taking cases. I just want to speak to my experiences with VLP. Our firm has been helping VLP since about 2013, right before Derek had gone full-time with VLP, who Zara then replaced Derek when he came over to our office. The experience has been incredible. It's great to work with these clients. As you'll find out through what VLP does in all aspects, you have clients who typically aren't going to be able to afford legal counsel. And tax issues, unfortunately, are complicated, whether it's $5,000 or $1 million at stake. Sometimes the issues are not all that different. So it really has been a rewarding experience. Derek specifically will talk about some of the issues that we do run into on the back end of this presentation with VLP clients that we typically don't run into with most of our clients. And again, even with those little issues that you have to work around for this space of clients, whether it's language issues or travel issues, it really is a rewarding experience. The clients work really hard to try to get everything they need to you. Trust me, you won't be sorry that you've gone into this program and that you're trying to help these clients, because they really do need it and they really do appreciate it. That said, I'm going to work into our presentation. So, like I started out with, the issues for a client who owes $5,000 versus $1 million really aren't always going to be that much different. Like, the cases are not necessarily less complicated. Typically, you just have smaller dollar amounts at issue. The process is the same. Sometimes that's good, sometimes that's bad. If you owe $1 million, you're going to go through the same deficiency processes, same collection processes as if you owe $5,000. There certainly are pieces along the way that are geared towards lower balances, lower income individuals, that are meant to help those individuals when they're working through their tax problems. It's important that as representatives that you have at least a good understanding of what those different aspects are, so that you can make sure you're taking advantage of those for your client. But again, the cases really aren't any less complicated. If you can work through a VLP case from deficiency through collections, you have a pretty solid understanding of what the process is at that point. And like I said before, Derek on the back end of the presentation will talk about some of the issues that affect low income and non-primary English speaking taxpayers, how you get around those, how you make sure that those individuals are still getting the representation that they need, that they should have in order to get fair treatment under the tax system. It won't come as a surprise to you that people who are having trouble enforcing their rights with the government often get trampled on. And that's where, as representatives, that's our job, is to make sure that they're getting a fair shake, whether it's on the specifically on the deficiency side, if the IRS is proposing more tax or proposing to eliminate a credit of some sort. And that's the same thing on the collection side. Again, balances aren't necessarily all that high for our VLP clients, but small amounts can mean a lot to these clients, especially when we're talking about withheld refunds. And often that's the type of issue that you might see is a dependency exemption for something similar that's been denied, and the client is desperately working to get that information in for a $2,000, a $3,000, or $4,000 refund. That might mean the world to them. So the front end of the presentation will be more general procedural stuff and how to work through that. As we get to the back end, it's much more specific on the VLP type clients. As Maria said on the beginning of the presentation, please just type the questions into the chat box. That should come up for me to see. Maria, if you don't see me answering questions that are coming up in the chat, bring my attention to it, because I probably just missed it. But we'll go from there. Since we're a small group, bouncing out for questions is really not any sort of issue. All right, Derek, if you want to go on to the next slide. So when you're taking in a tax case, there's a few basic items that you want to make sure that you're bringing in right at the front end. You want to make sure you have a solid understanding of what are the years and the type of tax that you're dealing with. Income tax is most likely going to be the primary thing you're going to deal with, but it could be employment tax. If you're dealing with clients who do have some state issues, you might also have sales tax in there. You want to know that. The other thing you want to know is, what years are you working with? Is it a deficiency issue over 2 or 3 years? Is it a collection issue over a decade? These are going to be important as you go through the process, because different rights are going to apply to pre-petition or pre-assessment type taxes where they're proposing an assessment versus collection issues. Why is it owed? And the biggest place where why is it owed would be, especially for lower income taxpayers, did they file a return, or is this what's called a substitute for return assessment? And that'll get more important as you move through the process, and Derek will chime in if I miss something, but we'll try to talk about why there's a distinction there and why that distinction is important. When was the tax assessed? If you're looking at tax years that are 2005, 2006 right now, those are probably 8, 10 years old almost. And again, this is going to be different between the IRS and New York State, but typically when an assessment with the IRS gets to be 10 years old, those are no longer valid and will be written off. Simplifying the process a little bit, but that's one of the things that you want to keep an eye for. You also want to know, again, was it assessed based on a return? Was it assessed based on an audit? Was it assessed based on a substitute for return? You want to make sure that you're tracking deadlines. Unfortunately, the IRS has a lot of deadlines, and they're often short. They can be 30 days, they can be 10 days, they can be 15 days. When it's coming to an issue of what's called a notice of deficiency, which I'll talk about in a little bit, that's your right to go to tax court. That's 90 days. So these deadlines are important, and for purposes of the tax court deadline, it's statutory, or it's jurisdictional. Sorry. If you don't meet your 90 days there, you're bounced out of tax court. So you want to make sure that you're identifying the relevant dates. There may be administrative rights that your client loses if you go past certain dates. So again, they're all over letters. The IRS is trying to get better about how they place them in their correspondence. They've made a concerted effort in the last 12 to 24 months to change that process a little bit. They've made the notices a bit more friendly to read. So that should be easier to identify, but it's important to go through notices completely because the deadline might be on page 3 instead of page 1. And you want to make sure you're identifying that. And as I mentioned before, determine if there's a state issue. If it's an income item, there very well could be a state issue. Most of the time there will be. If the amount is due to an audit, the state and the IRS share information. It can sometimes take several years to get there. But if there's an IRS adjustment, the state will usually have a corresponding adjustment. So you'll want to make sure you're identifying whether the state issue is there. Taxpayers often may not even realize that they have a state issue until they get levied on. So you just want to make sure that you're covering all of the open items for the client that you're bringing in.
And to chime in to follow Mike's point, Zara will provide you a summary of what's going on. So much of this preliminary case analysis will be completed before you even get the case. However, it's important to kind of know what could come up because oftentimes, as we'll talk about later, the clients will, and this is VLP and non-VLP, will often have no idea what's going on. So they'll think that there are certain deadlines they have to meet. They'll think there were certain deadlines that they missed, and they will think things have happened that have not happened, or they will think things have not happened that have happened. So, while this will likely be completed, or you'll get a good sense of what the case is upon referral, it's good to keep in mind that you want to have answers to these questions so you can determine the best path forward.
And to Derek's point, Derek before Zara and Zara currently, they do a great job of trying to vet what are the issues, what are the years, are there any impending deadlines that need to be addressed sooner rather than later, and they do a great job of that. But often, like Derek said, clients will have issues going on that they're not aware of. Sometimes they'll say, no, I don't have any New York issues, it's fine, it was taken care of, and they're thinking of 1 year was taken care of, but there's still 2 years outstanding. That happens all the time. So you'll just want to make sure that as you're going through the process with the client, you're keeping up to date. I'll get to this a little further in, so I guess I'll hold this point, but it's really important when you're dealing with the power of attorney, which is right there. To Derek's point on issues coming up after you're involved, the IRS power of attorney dictates what information you'll get from the IRS, whether it's correspondence from a service center, correspondence from a revenue agent or revenue officer locally, or it's talking to someone. They can't talk to you beyond your scope of your power of attorney. So if you limit your power of attorney to 2014 and 2015, but there's also a 2016 issue, you'll never see that correspondence. You likely will never know that's there. So it's really important when going through with the client the range of items that might be at issue. We typically will try to have a year early and a year later than what we know the issues are when we put in our power of attorney. It's probably about 1/3 of our cases end up having to get a revised power of attorney done because we find out there's a new issue. Something's come up while we've been working with the client, or there was just an issue that they weren't familiar with. that came up upon discussion or in talking with IRS. They will often tell you, look, there's something beyond what you're authorized for. I need you to expand your authorization. Completion of the 2848 is relatively simple on its face. You need the basic taxpayer information, name, address, social security number. You need your information. If you don't already have one, eventually you'll get a CAF number from the IRS. The CAF number is simply the internal identifier for you as a professional, similar to your social security number being an identifier for you as an individual. This is just one simple way that the IRS identifies me versus Derek or anyone else at our firm. Acts authorized are probably the most important spot, because here's where you're going to identify whether it's an income tax issue, whether it's a payroll tax issue, whether you're dealing with penalties, the forms, the years at issue, or the quarters at issue. This sets the scope of what you're going to be able to deal with for your client. And again, if you have something that's at issue but not on this form, unless you find an IRS person who you can actually talk to who tells you you need to expand, something could be going on and you'll never know it unless the client brings you additional information. Signature requirements for the taxpayer and for you as the representative. The IRS has been a little bit better about this, but they often bounce powers of attorney for the form not being clear, for date issues. If the taxpayer's signature is undated, they'll frequently bounce it. If the date between the taxpayer's signature and the representative's signature are too far apart, they'll bounce it. But for some reason you're dealing with a taxpayer who's in the capacity of a business, they'll bounce it if the titles don't match what the IRS thinks the title should be. These get bounced very frequently. That's not typically a big issue, except for right now in the post-COVID processing world, it's taking IRS much longer than it normally would to process these powers. We would frequently see these processed within maybe 3 to 6 days, and 6 days might be on the long end. Now we're looking more at 3 to 4 weeks on some. I think some that are over a month old that have not yet been processed. There's only a couple of service centers that receive the powers. They receive them via fax. They process them. You might go a month to 2 months before you even know a power has not been processed. They will send a letter to the taxpayer typically when they've bounced a power for some reason, but that can lay behind the process quite a bit. So it's important to try to have everything on here correctly and complete the first time, just so you don't have to go through the process of resubmitting. You don't have to worry about the power getting bounced and not knowing stuff is occurring while you should be getting correspondence but are not.
And a quick point on lines 4 through 6, they're not labeled in this because really in your case, you will likely be able to just ignore them. There are specific issues that come up where there might be specific acts authorized or specific acts not authorized. Line 6 is also for if there's already a power of attorney on file that you want to keep on file, that you have to make sure that that box is checked and you include the previous power of attorney. This will likely occur when a client or taxpayer has an accountant that they work with. Most VLP taxpayer or most VLP clients don't have an accountant they work with, or they're not keeping a previous power of attorney on file. So you really don't have to worry about that. I want to put those lines in because skipping from line 3 to line 7 doesn't really make sense to most people, but they're there. You can look at them. They really don't provide much value in the context of what you need to do for VLP clients.
Yeah, on that point, especially line 5A, you're rarely going to use those lines. So, just be cautious, especially on 6 when you're checking the box. Make sure that the power that's going with that's, apparently already submitted to IRS is complete and attached, because your power will revoke any previous power on the IRS system. So if I have a power in today and Derek submits one tomorrow without me on it, I'm going to get completely knocked off, which is okay in a lot of circumstances. If Derek wants to retain me on there as well, he has to check the box on line 6 include a copy. If the copy that's going with it is unclear, and sometimes it will be because we might be getting a fax of a scan or a fax of a fax comes to our office to include with this, they'll bounce it for that reason too. So you rarely will use 4 through 6, but if you're using 6 especially, just make sure you have a complete copy of the prior power and that it's a clear and legible copy, because if it's not, it will get bounced from the system. All right, so we have a couple of different levels of the process for IRS. You have contesting the liability, which is going to be the first thing we're going to talk about. I don't agree with the tax. The tax is wrong for whatever reason. And there's a few different ways you can get to the tax, and there's a few different ways you get to a wrong tax. We'll talk about those. And then after that, we move on to addressing collection of the liability. So dealing with the liability itself, it's always best if you can deal with it pre-assessment. Think of pre-assessment as a preliminary determination. This is what we're proposing the change be. It's not assessed yet. It's not on the books of the IRS. It's just there as a preliminary determination or proposal. I don't know what the level of experience with tax issues are for the group that's watching. I'm sorry if I'm kind of talking below you, but I want to just make sure I'm thorough on some of the basics here. So there's a few ways you can get to a pre-assessment proposal, if you will. You can be involved in the examination process. Not to spend too much time in exams, but you can be dealing with exams where you have to sit with a revenue agent or a tax compliance officer. You could have an exam where the IRS picks up 1099 income that maybe the client didn't include. You can have a non-filer exam where the IRS says, we have your W-2, we have your 1099s. Here's what we're proposing your tax liability is going to be. Let us know if you think this is wrong. Exam is the best place to get involved, if at all possible. It's also the first place where you can really make sure that you're getting the most out of your administrative rights with the IRS. This is where you have an opportunity to present the information, whether it's via service center or a local auditor or compliance officer. You send documentation, you send expense substantiation, whatever they're looking for, you would submit it through this process. Office audit locally has been somewhat aggressive on their determinations. If at the end of the exam, you don't come to a conclusion that is agreeable to you and the client, then you can exercise your next set of rights. Leaving examination, you're going to get one or both of a couple of different letters. There's what's called a 30-day letter that will allow you to go to appeals, and there's a statutory notice that allows you to go directly to the U.S. tax court. As I mentioned before, the statutory notice of deficiency gives you 90 days. That is locked in, jurisdictional. If you don't get in there in the 90 days, you'll lose your tax court rights. And at that point, you'll have lost your pre-assessment rights to fight the balance. Appeals is again within the administrative process. Leave an exam, if you get the 30-day letter and you do what's called a protest, you'll go to IRS appeals directly without having to go to the tax court first. IRS typically has 3 years to assess from the time a return is filed. Under 6501, there's a number of exceptions to that, and I won't get into all of those right now, but it's important to understand that the baseline is going to be 3 years from the filing of the return. And why this becomes important is IRS is incredibly protective of statutes. That's fine, they should be. They don't want to blow it, they don't want to get in trouble. It is incredibly bad to be the individual at IRS who let a statute expire. Because of that, they'll be doing one of two things. They'll either be looking for statute extensions. The statute extension is an 872 form. It's entirely voluntary. Unfortunately, when you're talking to the IRS, it won't sound voluntary a lot of the time, but your client does not have to sign the statute extension. In our office, I would tell you it's probably about a 50-50 proposition on whether or not we'll do the statute extension. If we're in a position where we think the additional time helps our client, we can substantiate information. We think we have a good working relationship with the auditor or the appeals officer. This can come up in appeals as well. we'll do it. If we feel like there's been delay, that our client's not getting a fair review of their tax issues, then we'll refuse to do it. If you refuse to do the statute extension when it's requested, they'll typically issue you statutory notice, and again, that's going to be your right to go to tax court. If you're going directly to appeals, you have time on the statute, or you've signed an 872, it's an informal process. You'll have an appeals conference. The appeals conferences have become almost exclusively at this point telephonic. Buffalo is kind of slowly losing its appeals officers and settlement officers, but that's a collection issue. If you exercise your rights there, you come to agreement, you'll sign, you'll either have your balance conceded, or you'll sign an agreement and get on your way to either having no liability or moving on to collections. You can't find agreement there, you'll end up in tax court. After you go to tax court, if you haven't had the opportunity to go to appeals yet, you can get post petition appeals, which is simply working with an appeals officer while you have a docketed tax court case. Again, if you're working with appeals there, it's really the same process. If you're not working with appeals at this point, you're working with a IRS counsel attorney. Counsel attorneys are there to try to resolve the cases. If you can find agreement, great. If not, you're moving on to trial. Assuming we get past this, now we've got a case where the assessment came in, it's already final, and you're trying to contest it. Your options here are a little bit more limited, but it doesn't have to mean that it's not going to be effective. Your post-assessment options for contesting the liability are generally going to be an audit reconsideration, an offer doubt as to liability, or filing the returns. Often we'll have clients who have substitute for returns filed for them by the IRS. That sets liability that is almost in all cases wrong. It doesn't account for any exemptions. They usually is going to be married filing separate or single. It's just not going to be a correct return. Often just filing the return with all the same income and doing the return correctly will bring the balance down significantly. If you have a situation where you had an audit assessment that was never protested or taken to tax court, you can submit what's called an audit reconsideration. That will typically go back to the same auditor who had the case in the first instance. Often that can be a little bit difficult because you're telling them they're wrong. If you have an audit that wasn't responded to originally, that's a little bit easier process, but you'll go through the reconsideration. They'll look at any additional arguments or documentation that you're providing. They'll issue a determination, and then that also has an appeals right to it. Finally, you can go through the offer and compromise process. This will come into a little bit more clarity in the collection side, but essentially submitting the offer would submit the offer forms. It's a form 656L, and there would be an explanation as to why the liability is wrong. Sometimes this can have amended returns submitted with it. It can be a legal argument on an issue. It'll go to an offer reviewer, and you can also move to appeals on this if you don't come to an agreement with the offer reviewer. But this is really just another way, like audit reconsideration, to get that balance adjusted for your client if you don't have your pre-assessment appeals or tax court rights. All right, now we're into the collection phase of cases. There's a couple of codes that you guys will need for this as we move through. So the first code is going to be collection, and then there'll be a second code in the latter half of the presentation. So we're going to move into collection cases. The tax has been assessed, and we're going to assume the liability is correct at this time. Self-assessed liability is simply what's shown on the return. I prepare my return, I say I owe $5,000, but I can't pay it. I now have a self-assessed liability that's gone unpaid. IRS determines the liability. Audit, substitute for return, any sort of adjustment the IRS is making that you no longer have a basis to dispute. Whether you don't have the information to dispute it, or you don't have any legal basis to dispute it, the liability is fixed and final, and now you're just trying to deal with the collection aspect of it. If the taxpayer can pay the tax, penalty, interest in full, probably not doing much with that client. It's very rare that people can do that, and it's very rare that anyone wants to do that. If you can't do that, then you do require what's called a collection alternative. Through the IRS process, there's a couple of different collection alternatives that are on the next slide. Currently not collectible is the most basic collection alternative that's available. It's simply kicking the can down the road for the client. The IRS will look for financial information. If they determine that the client can't currently pay, they'll place them in currently not collectible status. The client can stay in that status for really any number of months or years. Typically, the IRS will tell you that they'll review it every 12 or 24 months. I've had some clients who were able to sit there for 2 or 3 years, some clients who seem to get bounced out of it after about 6 or 9 months. It is not a permanent solution. Typically, if we're putting someone in currently not collectible status, it's just to take the pressure off of collection at the moment and to figure out a better long-term option. While it's in currently not collectible status, it will still accrue penalty and interest just as it would at any other time. There's really very little benefit to the client here other than, like I say, it's you get out of the frying pan. You're not being levied on, you're not being pursued by collections at that moment in time, but it's not a long-term option. Installment payment agreements. In its most basic form, this is really no different than any installment loan that you might have. You have a monthly payment, there's interest being charged as the time runs, and it's typically going to be over a set period of time. The IRS prefers to collect in full on installment payment agreement, but they will do what's called partial pay installment agreements, which simplified is over the time that's remaining on the collection statute, which in most cases should be 10 years. They'll take a monthly payment that will not full pay the balance. Again, with the installment agreement, just like currently not collectible, your interest is still accruing, so the balances will grow sometimes significantly when you're dealing with that. It's not usually the best option for low income VLP type clients, simply because it's going to cost them more money over time. Typically, it's funds that they don't have. The IRS does try to accommodate for the issues of how much can you pay, is this a reasonable amount? But again, it's just going to prolong the amount that has to be paid, and it is a long-term solution for some clients. It's not necessarily the best solution for especially low-income clients. All right. Then the next option that we have is offer and compromise. As I mentioned before, there's a couple of different varieties of offer and compromise. There is what's called doubt as to collectability, which is a purely collection type issue. And the doubt as to liability that we talked about before is not a collection issue. It's simply, I don't owe that tax, whether I owe less tax because I didn't respond to my audit or because there's some error that's been made. I don't owe that much tax. Now you can submit both a doubt as to liability offer and then later submit a doubt as to collectability offer. You're not foreclosed from submitting both. At the end of the process, the goal of the offer and compromise is to simply pay less than what is owed. The pure doubt as to collectability offer will allow you to pay less than is owed because you don't have the funds. Your client doesn't have the funds. IRS uses a term that's called reasonable collection potential. And what that tries to do is look at excess monthly income of the taxpayer and equity and assets to come up with what they believe is this reasonable collection potential. Sorry, Derek, I'm skipping around on how the slides are laid out. When the IRS comes up with this number, if that number is purely less than the tax, that's typically a very strong offer for the IRS to accept. You may have a client who has no monthly excess income. That's great. You may have a client who has significant assets or at least significant enough equity and assets that the tax might be fully collectible. Because of that, there's a couple of different variations within the collectability offers. You want to flip back to the other, there we go.
Or go forward.
Perfect. Collectability with special circumstances. This is less than RCP, but the RCP here is also less than the tax owed. So if I owe $1,000 and my RCP is 800, but I'm offering 400. These are typically on hardship grounds or public policy equity grounds. We've had some, I think most of my special circumstances cases typically deal with medical expenses that are coming up. It can vary some. The issue, and I'm sorry, Derek, because I'm going to skip around on slides again, but an issue that will come up frequently, especially as you get into higher earning taxpayers, a little bit less so with lower income taxpayers, is that the net monthly income, so you take your client's income less allowable expenses, often does not line up with what is their actual expense. Allowable expenses are frequently going to be less than what their actual expense is. Sometimes that's a circumstance where it's best to make the argument under special circumstances because their actual expense exceeds the allowable expenses for some important reason. I believe on the handout that you have with this is a summary of some of the allowable expenses that IRS uses for their collection review. Just flipping down to that part of the handout.
That's right, Mike. We included the housing, the food, the out-of-pocket healthcare expense, and the transportation because they're a good basis for determining collectability. And as you'll see, they're not a lot of money. The IRS, these standards don't provide, really the opportunity to have substantial expenses in any area outside of maybe having a large car expense. The monthly expense for a vehicle is over $500 a month for just the ownership. But to Mike's point, fitting, the purpose of showing these three types of offers is how do you fit the taxpayer? How do you fit your client into the system that's been set up by the IRS to give them, the quote unquote fresh start that, you see on and hear on all the commercials. So, special circumstances, and I'll let Mike finish up with the effective tax administration. There's essentially three, sections. There's collectability, there's special circumstances, then there's effective tax administration, all of which could potentially be the solution, be the relief that your client needs. Just depends on what their RCP is.
And as a kind of a quick reference, and you don't have to take a look at it right now, but if you're looking at housing allowance for a family of 5, if you're in Erie County, that's $1,924 a month. If you're in Chautauqua County, that's $1,540 a month. Now, the economics of Chautauqua County, Erie County are quite a bit different in some circumstances. But if you're housing a family of 5, are you necessarily going to be spending $400 a month less if you're in Hamburg versus Dunkirk? Probably not. So these allowable amounts don't always tell the story. And that's where sometimes, whether it's special circumstances or it's ETA, it's got to be advocated. And that's one of the things here is you are an advocate, even though you're dealing with the government and these issues. You're still an advocate. It's trying to find the best path for your client. So the ETA offers, the effective tax administration, different than special circumstances. Here, the offer amount is less than the reasonable collection potential, and the reasonable collection potential is greater than the tax amount owed. These offers are very rare to actually get through. I think I've had a couple of denied in the last year or so. Again, the biggest things you're going to be dealing with here are relatively certain anticipated medical expenses, family expenses. When you're dealing with lower income clients, it can be a lot of various things that are coming up in their lives. Healthcare expenses are an incredibly, important one. And more often than not, when I'm dealing with this kind of offer, health is a major circumstance there. We will sometimes have these types of offers, the effective tax administration, when we're dealing with individuals who are in retirement. maybe they can pay the full amount of the tax, but their income is not going to support them on its own, and whatever savings, which is usually modest, they need for their day-to-day survival. Or their income appears to be kicking off a little bit extra right now, but again, it's an uncertain amount of income. Maybe they're working part-time and they're otherwise on Social Security. This is really where, in the offer circumstance, you can advocate for your client. On the pure collectability offers, it really is more of a math problem. On special circumstances, doubt as to liability, effective tax administration, this is where, as lawyers, we advocate. This is the place to tell your client's story, get out what their issue is, what their problem is, and what they need to, they need your help to get this balance down.
And to follow that, Mike, here's a very simple effective tax administration situation that occurs with VLP clients. As they own a home without a mortgage. It's in the city of Buffalo. Maybe the home's value is anywhere from $30,000 to $50,000. A very modest home in the city, maybe purchased at a foreclosure auction or purchased with cash potentially, because home values were so suppressed or so depressed in the city for so long. They owe taxes of $8,000. Their expenses exceed their income. They can't afford to pay. Maybe they're on Social Security, disability, or Social Security. They're retired. That is an effective tax administration offer because they have equity in their home that exceeds the tax amount, despite the fact that their expenses exceed their income or very nearly their income, and they're never going to be able to pay that tax amount. So that is a situation where you can advocate for your client and say, they can't access this equity. Furthermore, it's modest equity at best, and if they were to sell their home and pay the tax, would they be able to purchase another home like it, or would they be able to move into similar dwelling and rent? When their expenses already exceed their income and they don't have a rent or a mortgage payment, then the answer is probably no. So that is a situation that's very common, unfortunately, and it's also a situation where you can say, look, it has to be effective tax administration because the house is valued at a certain amount of money. But I think it's a very valid argument to try to push through. And in the interest, we're going to go through offer issues. Mike kind of touched on this: forms versus reality. It's a kind of a crude way of saying, how do these standards, these IRS expenses that are listed, fit in with what is actually going on with your client? Does the $56 a month out-of-pocket healthcare standard match what they're actually paying, and can they show it? Documentation incomplete. Oh, we got something here. Is this a question or a chat? Oh, that's a good point, Mike. I should put my video on. So documentation incomplete or unavailable. If there are out-of-pocket healthcare expenses that exceed the standard, can they be proven? Does the client have the receipts? As you can imagine, sometimes clients, whether they're BLP or not BLP, are not the greatest record keepers. That could be potentially why they have a tax issue in the first place. So here they are. They don't have the necessary documentation to show that their expenses exceed a standard or that it's required, they're required necessary expenses. Current year, future filing, and payment compliance issues. Very simply, if you're pursuing an offer, acceptance would require that the client, the taxpayer, be in compliance for the next 5 years in filing and payment. So are they somebody who has rung up 5 or 6 straight years of liabilities? Maybe they're not withholding enough. What is the nature of how that tax liability came about, going back to the preliminary case analysis? So you might be able to advise them on how to best fix their issue. Maybe they should change their withholding for their job from single 1 to single 0. Maybe they receive unemployment, which is taxable, which we're going to get into a little later about why this is a very important thing to touch on. And or they have other sources of income that are taxable that they're not dealing with. Lastly, audit risk issues, kind of similar. You want to be able to know that if they are in compliance with filing and payment, that their most recent 3 years don't present an audit risk. If you pull a transcript for a client and you see there's a 1099-C, which is a cancellation of debt form, and it was not addressed on the tax return, then it needs to be addressed before you pursue an offer. Otherwise, the client could get audited and it could default their offer, and then they got to start over.
And just to jump in on a couple of quick items that Derek just talked about, with respect to current and future filing compliance, you need to be in filing and payment compliance to submit the offer in the first place and to have it considered. And considering offers can sit outstanding for up to 24 months. That is a current issue when you're at the submission of the offer time period. Staying current with your filing and your payments are also necessary for an installment agreement. With respect to the audit risk issue that Derek just talked about, it's also important if there's a clear issue in especially a recent year, that get addressed up front, because if there's a balance that's going to end up being higher, it's better to have that set before you submit the offer. Like Derek said, it gets audited later, adjusted, and then maybe that offer ultimately gets defaulted.
Yes. Quickly through income, all sources of household income, not just taxable sources. So if client receives Social Security disability, when you're factoring in the income versus expenses, that is counted. Also non-taxable sources, big one in the VLP world, workman's comp. Not a taxable source. There's really no record of it with the IRS. But if people are receiving it, that is considered a source of income for purposes of determining the reasonable collection potential. People receive income in various ways: monthly, weekly, biweekly, semi-monthly, easily extrapolated out, multiplied by 4.3, biweekly 2.17, I think for the IRS. I think for VLP it's 2.15. So there's going to be a very minor difference there. For expenses, the IRS standards are reasonable and necessary. Well, that can vary greatly from person to person. If you have somebody who has a medical issue, you have a single parent with small children who have daycare, what does reasonable and necessary mean? Is $400 a month in daycare, is $200 a month in daycare, $600 a month? So, we always try to take the actual expenses as they are. There's going to be instances where the IRS is going to say that they're not going to allow a full expense on a collection statement. That happens. It's probably the first one I ever did. It happened. It happens to everybody. You just want to do the best you can to say to the IRS, if this is an expense that is required, it is necessary, that the taxpayer cannot live without it, then they need to allow that full expense. And the Internal Revenue Manual, which was mentioned previously, is a great tool to use in that case. Shared expenses, if you have two spouses, normally one liable, one non-liable, then you might have an instance where you need to determine the shared expenses. It's based off the income percentage. So if one spouse makes 80% of the household income, the other spouse makes 20% of the household income, then you are just, depending on who is the liable person, you're using that percentage or the single person expense, whichever is greater normally. And like I said before, expenses above the standards, they need to be substantiated. The best example is if you have housing above the standard or food. If you have a client who's diabetic and they have specific dietary needs that need to go above the standard that the IRS allows for monthly expenses, then that's a perfect example. There's obviously going to be many, many more examples, but we need to buzz through a few more of these. The net realizable equity, biggest one, the home. People have bank accounts, any assets. If you're taking the fair market value of those, if they're not, liquid or cash-based, like a bank account or a retirement account, So, I mean, the home is the biggest one. There's the car as well. For a car, they allow an equity expense of $34.50 after you take out the loan and you take the quick sale value of it. Quick sale value of a car and a house on the form is 80%. They do not have an allowance for the home for people who own homes, which is, I think, insane, but that's what we're dealing with. And then going down. So if there is equity, can the equity be excluded from the RCP? If it's a home equity, can it be excluded because they can't sell the home and move into a likewise property? Would they get denied? A good way to go about this is have your client potentially apply, see if they can get pre-approved for a HELOC, a home equity line of credit. If they can't because they have a tax lien or they just filed bankruptcy, then you're in a situation where you can tell the IRS, look, nobody's going to give them cash for their equity. We should exclude the equity from the offer. That's something that's very common. The offer narrative, this goes back to telling the story. You want to be able to formulate to the best of your ability and to the best of your client's ability a story that indicates why they will not be able to pay the full amount owed over the life of the statute. The goal is to just be as honest and open and upfront as possible. Facts that could be added that don't end up on the form: age, health, earning potential, savings, location. A taxpayer that's in the city of Buffalo is going to be situated differently than a taxpayer that's located in Williamsville or Rochester or any other of the vast areas. How the tax liability arose might be something you want to include. Sometimes the tax liability arose out of our clients not doing what they were supposed to be doing, which is how most of them arise. So it's just be cognizant of that, because the IRS does have the ability to reject offers based on public policy. Accepted offers are public record. You can go view them if you're so inclined, probably after this COVID thing in the IRS office, actually on South Elmwood in Buffalo. It's one of the places around the country where they keep accepted offers to be viewed by the public. It's just something, if the tax liability arose because your client in a past life wasn't doing what they were supposed to be doing, then it's really irrelevant for purposes of determining collectability. But, the IRS is not going to reward people for failing to do what they were supposed to do and being compliant, although they rarely bring up the public policy rule to reject an offer. So there are laws, regulations, and the IRM provisions, the Internal Revenue Manual. Perfect chances to go find examples. The IRM provisions that you want are 5.8.5 and 5.15.1. Those are the financial analysis, and each of them, they're very similar, but they kind of differ in certain areas when they talk about expenses and equity. Offer review, the IRS may request additional documentation or follow-up. However, unless the situation has drastically changed, they will not do so. The example I used to use all the time at VLP was, the lottery example. If you submit an offer and then you win the lottery, you probably are no longer eligible for an offer. Even if you, at the time you submitted the offer, you were not in a position to full pay the tax. They generally will ask one or two questions. I always tell people that the IRS will ask at least one question usually when they check on an offer in the review process. The goal is to have as few questions asked as possible. The goal is to make it as easy as possible for them to accept the offer. I was fortunate enough to just have another offer accepted for a VLP client not too long ago, and the IRS examiner said that he wished they were all this easy. And when you're dealing with low-income people, they should be more simpler than when you're dealing with people that might have many different types of assets or business interests. But you want to be able to, you don't want them finding something that you didn't know about.
And on that point, Derek, I've only ever had VLP offers accepted in this manner, but I've had at least 3 or 4 accepted with no back and forth, no discussion with IRS at all. The offer is submitted, reviewed, and I get a letter saying it's been accepted. So, like they're saying, if everything is lined up just right, it can be a very easy process too once it's submitted.
Right. So acceptance, the biggest thing to advise and re-advise the client, you don't have to keep them for 5 years after acceptance, but to make sure to comply with the payment terms. We didn't even talk about payment terms for offers. I must have skipped the slide, but the payment terms can be one of two things: a lump sum, which is paid within 5 months of acceptance, or a periodic payment that is paid between 6 and 24 months. Generally speaking, when you're dealing with VLP clients, low-income clients, they will be lump sum paid within 5 months. My general rule on submitting offers where there's no equity and there's no, the expenses exceed the income, is I offer $10. And I know other clinics around the country in the past have offered $1 and they've had them accepted without issue. So, I think, you just find the comfort level for you and your client. But I mean, there's no illegitimacy to making an offer that's the minimal offer amount that the client can pay, because you're showing the IRS that they don't have the ability to. Filing and payment compliance for 5 years, incredibly important. Right before I left VLP, I had a client call me and say that she had just finished making, this was the weird case where we actually did a periodic payment plan for 24 months. She had just finished paying it, and then she told me that she didn't think she had filed her most recent tax return. So I panicked a little bit, but I did talk to her and she was able to get the return filed. We confirmed it with the IRS. So, that was not inside the 5 years, but you need to make sure they're aware of that. Also, the other thing that trips people up, there's a refund offset for tax liabilities generally. It occurs into the year the offer is accepted. So if you're submitting an offer now, it's going to run into 2021. They will have their 2020 and 2021 offers or refunds offset. If they're a client who has an earned income tax credit coming, that's pretty unfortunate oftentimes, because they'll have a pretty substantial refund. Rejection, you can appeal. If you're not through a collection due process hearing, which we didn't even talk about, but it's one of those deadlines you got to watch for. You can have judicial review. You can take it to tax court. It's an abuse of discretion standard. It's a pretty high bar. Otherwise, you can informally protest. You can ask to speak to the manager of an offer specialist. Sometimes that kicks them into gear. Usually they're very reasonable people. Also, you can pursue other collection alternatives. If it's a case where you need to, you need to just get them over the 10-year collection statute expiration date, maybe currently not collectible is a better option than pursuing an offer, just because, there's a very limited period of time left on the statute. The goal is to not get your offer rejected, but it does happen. You'll run into an IRS employee who doesn't want to accept for some reason. But if you're thorough and upfront, hopefully you won't have to deal with this stage. Now, so we're right on about an hour, which is, timing-wise, we're doing pretty well. So we want to touch on the last 30 minutes of this with the access to the tax system itself, and specifically how you can help low-income taxpayers, ESL. I know there's very different ways to explain, but English as a second language, limited English proficiency taxpayers, and solutions and workarounds. So no client is going to be the same. There are going to be issues that are specific to limited English speaking clients. How can you still provide them the best service? How can you still protect their rights, make sure the IRS is not infringing on their taxpayer rights, and hopefully get them the result that you're looking for, and the best result for them. So general issues. The tax system's complicated. We sit in this office, this firm, And it's not uncommon that once a week or more, every day, something comes up where we go, man, we haven't seen that issue before. So it's very important to remember that when you're an attorney, or I know there's some law students here, that your clients, if they're VLP clients, may have limited education, they may have limited literacy generally, and they also may not speak English or have a limited understanding of English. So they're going to get a letter from the IRS, and it's going to be a CP 2000 audit letter that says, proposed adjustments or proposed changes of $6,783, and they're just going to think it's a bill because it's got in big bold numbers the amount and proposed changes, and yet that letter is going to give them 30 days to respond. And going back to when Mike was talking about examination, in examination, very likely you're going to be dealing with correspondence exam, which is going to be through the mail. You're not going to have direct contact with an IRS employee or an IRS agent until somebody is actually responding to your response. The initial correspondence is just going to be through one of the campuses. So, make sure that deadlines are met, and make sure that you are relaying to your client that this mail is very, very important. Many clients will come in, and this happened when I was at VLP, and it happens here. They'll show up at the office, or they'll send in unopened mail from the IRS that could be years old. And in that is lost deadlines and lost opportunities to contest liabilities. So it's very important to make sure you're on top of the course, especially when you're dealing with somebody who has limited English proficiency, who might not even, they won't be able to read the notice that is being sent out. The IRS is intimidating. Everybody's afraid of the IRS. In my personal experience, I think the IRS is actually been a pretty easy agency to work with. I think New York State is really a pain. Hope no New York State people are on here. But they are very reasonable. So if you present them the correct documentation, or you present them documentation that supports your position, they are going to work to try to reach a result. They will compromise. They'll negotiate. The other thing that is a general issue that affects VLP clients is tax issues can linger for a long time. It's not uncommon that you will come across somebody who has tax liabilities for 2007 through 2010, and they didn't file returns, so they were filed by substitutes. And here we are in 2020, and what could have been resolved at the time, unfortunately, there's no way to deal with it now, because maybe it required showing that they had an issue with insolvency. Maybe it required sending in birth certificates for their son and daughter. And now, 12 years later, 13 years later, there's no way to appropriately get to the crux of the issue, but they're sitting with a balance owed to the IRS of $15,000, and there's still time for the IRS to collect. So it's important to go back to the preliminary case analysis, figure out the years, figure out how we got here, because figuring out how we got here might be a way in which we can help dig this client out of this tax mess. And it's not uncommon also, especially for ESL taxpayers, immigrants, refugees, especially initially when they come to the United States, to move around a lot too. So in that same vein, they might have missed notices because they might have had an address in another state, and all of a sudden they move, they end up in Buffalo, and they haven't received any of the notices for the last few years that could have very well helped resolve this issue. So it's important to make sure that when you're any client you're dealing with, but especially somebody who is an ESL taxpayer, make sure all their information is up to date with the IRS, so you can most efficiently represent them. And then access issues specific to ESL taxpayers. Most notices are only in English. The IRS will send out some notices in Spanish. They're usually targeted notices. They're not general notices. So, the IRS will send these notices out in English and then just assume everybody has the ability to read them. IRS policy is that the notices are supposed to be legible to somebody with a 6th grade education. And if anyone here has ever seen any notice from the IRS, I don't know how that possibly could be what they were, the notices they have could get at, because as Mike mentioned, there might be a deadline on the 3rd page, but the front page will say $11,000 proposed change. And on the 3rd page, it'll say, yeah, but if you respond within 30 days with the right documentation, then, this could be less. So, it's the information is not always up front. Availability of documentation. This is a huge one for immigrants and refugees who are being audited, because you'll have a scenario where the IRS will say, okay, you claimed these 3 people as your children, prove to us that they're your children. And they'll be from Burma, and they want to have birth certificates, because it's nearly impossible to get birth certificates from Burma unless they brought them over with them while they were in refugee camps and they kept the documentation. It's very rare. It's incredibly rare. And so what do? How do you prove that somebody is related to another person? Obviously, for your client, they'll say, well, yeah, these are my children, but the IRS will want more. The way to get around that is alternative documentation. I'm going to skip between the last 2 slides, really, 2 or 3 slides. But the best way to deal with that is to come up with an alternative. And for example, in the case of a taxpayer who doesn't have access to their birth certificate or the birth certificates of their children because they're from a country that either doesn't have them, or they were not provided, or they were lost as they made their way to the United States, then showing the information from the refugee resettlement organizations. There's a few of them in Buffalo. They've been fantastic at helping provide documentation when necessary. You can ask them for, the UN, I believe it's the UNHCR, HRC, the United Nations Human Rights Council documentation for when they were in refugee camp. It'll show their relationship, and ideally, the IRS will accept that documentation. Now, I had one case where the IRS said, well, if you don't have birth certificates, I'm not verifying that these people were related. So we said, that's fine, push the case along. And we had to go all the way to tax court, and we had to go all the way to a few weeks before trial, to where the chief counsel's attorney and their staff said, yes, this is fine. This shows. So don't give up. If one layer of the IRS doesn't agree with you, then you can always push it on to the next one in hopes that somebody does. Another big one for ESL taxpayers is trust in the system. Many people that are, especially refugees that are resettled here, do not trust the government. And in a lot of cases, for good reason. They come from countries where they were in situations that they were, violently removed from their homes, or they were kind of vilified for their religious beliefs, or vilified for being part of an ethnic group. So, they come here obviously they know that it's a different country, but they still have that doubt. One of the old VLP staff people no longer works there. He was from Africa. He used to say a lot of people, they'd rather, trust the devil you know than the angel who's a stranger. And so a lot of times they will be more likely to trust people in their community who may be doing, to go to the next bullet, who may be providing misinformation, who may be in support of certain tax preparation scams, as opposed to trusting somebody from the government or from an institution because it's just more familiar for them, it's easier for them. So you need to keep that in mind when you're dealing with an ESL taxpayer, especially a refugee or an asylee, that their life experience is drastically different than somebody who was just born here and has grew up here. So you want to be able to make sure that you can ensure them that the system and the safeguards that are in place that we're relying on to represent them are followed, and to kind of reassure them and assure them that this the system, while not perfect, is something that they should be able to trust and build that with them. Scams, and one of the reasons I got hired out here 5.5 years ago, almost 6 years ago now, was because there was a Burmese tax preparation scam that hit about 1,000 to 1,200 refugees and immigrants within the city of Buffalo, where they were the tax preparers were claiming education credits on their tax returns without the client's knowledge, and taking, absconding with some or all of the money from these returns. The IRS, of course, caught this because it was a fairly easy catch because the information returns didn't match. They audited many of them, and it created a huge logjam. Now, a lot of them didn't get audited, but a few dozen of them for sure got audited here. Some people paid the tax that was owed. Others we got offers for. Others we worked with payment plans, or it was a difficult scenario. But it's important to remember that there's a lot of misinformation. There's a lot of scams in the communities. And people are preying on their lack of trust in the system and preying on the fact that they may speak the same language to maybe steal their money, or charge exorbitant fees for tax preparation when the tax preparation is very poor, or borderline fraudulent. So
on that last point that you were just talking about, Derek, we had a few of the Burmese clients, and some of the clients that I had from that situation spoke no English. And so while there's certainly the issue of dealing with the devil you know versus the angel that's a stranger, there's also just the basic need of, I have to do this thing, filing a return, and I need to work with somebody who understands me. And within the Burmese community, there was this preparer who was trusted, but was able to abuse that trust because, especially these taxpayers who spoke no English, they had no idea what was going on in the return. They were just trusting that everything was being done correctly and had no way to verify that themselves. And that, unfortunately, is a big issue with taxpayers who either don't speak English or who have limited English, especially since a taxpayer might have limited English spoken, but may have very little or minimal ability to read English. So those are issues that sometimes, unfortunately, these individuals are just stuck with. Another couple of items on availability of documentation. Derek was making the point, which is a really tough one to get around, of documentation on relationships, but there's also the issue of financial documentation. You're often going to be dealing with people who are, they call them unbanked. They don't have bank accounts. They rely on the green dot type cards. They rely on cash transactions. And unfortunately, cash has kind of gotten this spin with the IRS and New York State tax of something is wrong. But these individuals, they're often living, week to week. They don't have a bank account. They don't maybe even need a bank account, but it's very difficult to show someone's financial situation when everything is in and out in cash, because there's just nothing to rely on there. And sometimes you may have to get creative with how you go about documenting what their finances are, whether it's money in or money out.
Yeah, and that's a good point. Now, actually, I can segue that into I was just thinking of this example of a recent client who we settled his tax court case. It was another instance where, documentation provided at one level was not enough until we got to the next level. And this is a case of a gentleman from the Middle East who was a cab driver, and he received two 1099s from the same company for about the same amount of money. It was off by like a grand or two. And it was clearly a case where the income reported was in excess. It looked like actually they were off by a decimal point, where they said 40,000 instead of 4,000. And there's a presumption when those information returns are filed that they're correct until you can rebut that presumption. And now, how do you do that? In his case, and much to the chagrin of the appeals officer we were dealing with, the only way to really rebut that was to show every single daily log of him driving and the income reported for the entire year that he worked for this company. So we did. So we compiled every day that he had a handwritten log from when he was in the car, and we had every single one, and we compiled, and I provided summaries for the appeals officer to say, this is the only way that the cab company wouldn't return my calls. I called them a ton of times. And this was the only way to show the IRS that he really didn't make this money. We had bank statements that showed that he wasn't stockpiling funds anywhere. And it was a difficult case because it requires the IRS to take your information and to truly believe it at its value. And that's not the ideal scenario. You want to have kind of more straightforward documentation cases if you're dealing with an audit of somebody based on the earned income tax credit, which is a very common VLP case. We didn't really talk about it, but it's especially for the ESL community. You want to have just the school letters, the birth certificates, and line it up, and it should be a very simple substantiation. But this financial documents were from a taxpayer who qualified for VLP services, had 2 kids. I mean, it wasn't a case where this is somebody who is making a ton of money, but we had to provide nearly 200 pages of, actually it was more than 200 pages of documentation to the IRS to finally get them to agree to lower the assessment. And the reason I bring that up is because, you don't want to give up. And we'll jump to the last slide for the last couple minutes. The biggest 2 bullets here are the first 2. You need to have patience. And, I know that's not something they teach in law school, but, you want to be able to, oh yes, good point. Well, so before we talk about that, now that we're in the last 10 minutes, the second code for the CLE is compromise. So the second code is compromise. So the solutions and the workarounds, sometimes it just requires patience, and I'll add persistence, because it's not just VLP clients. Sometimes they won't provide you the documentation you request. Sometimes they'll provide you the wrong documentation. Sometimes they'll provide you everything that you ask for in a perfectly timely manner, and you'll get it to the IRS and they'll still say no, or they'll still deny you. But you can persist. And fortunately, when dealing with the IRS, there are multiple layers generally where you can see that your client's case is heard. So if it's in an offer context, you can make sure that your clients, you can appeal a rejection. If it's in an audit of, a Burmese taxpayer who claimed her children and were disallowed, then you can appeal. You can go to tax court. They're generally more complex cases, but you can get the result. But it does require, especially when you're dealing with people that English is not their first language, to sometimes take a step back. You may be frustrated at certain points, but just know that there will be time, and they genuinely are working to get it resolved. We talked about the alternative substantiation a bit. Their UN refugee documentation in place of birth certificates doesn't always work at certain levels of the IRS. They want birth certificates, but you persist. You provide that information. And then, the last thing that I think is kind of an important strategy sometimes is the path of least resistance. And I don't mean giving up any of your clients' rights to solve the case. The path of least resistance really is working with the client to come up with the most suitable outcome. So maybe it's a case where the client is being audited for unreported income, but it's really, they still have appeal rights, they still have tax court rights, but it's very difficult to show that any of the income was reported incorrectly. Then, it might make sense to get them a collection alternative sooner rather than later. Pursue an offer, pursue currently not collectible. Another good example of the path of least resistance is for those of you who have any experience in bankruptcy. Maybe instead of doing an offer, the client could get a bankruptcy. VLP does bankruptcies. Occasionally, when there's tax debt that's dischargeable, that you can get a bankruptcy. Maybe your client has other debts. So it's important to kind of keep the overarching fact pattern, the client's issues in mind. But also, to going back, sometimes they won't want to pursue a certain course of action. Maybe they're in the process of having their immigration status changed, and they don't want to deal with certain aspects of it. You just need to keep in mind that there's other things going on. Usually, I remember one of the old attorneys at VLP says that no one ever just has a tax issue. They have life going on and different issues. So it's worth keeping that in mind. There was a bunch of things we didn't touch on in this presentation, and Mike and I had talked before that we could talk about this stuff, VLP specific stuff, for days, and we do sometimes. But the takeaway I want you to have is that the value of your service to these clients far exceeds, in my opinion, what you get out of it. You'll get CLE credit. If you're new attorneys, you can carry some of that over, but it doesn't even count toward the first year. But giving, a client the opportunity, whether it's in a collection context, to, start again and not have to worry about having their refunds taken, or don't have to worry about a potential bank account levy or a Social Security levy, or a client who has maybe been in the country for a year or two and has children and is just trying to figure everything out. As difficult as that is, giving them the opportunity to make sure that you can get the IRS off their back, it's even the value of that exceeds the money that sometimes you save a client or you get into a client's pocket. You're giving people hope, and in the end, you'll get CLE credit, VLP will be grateful and the client will be grateful, but you're having the opportunity. These cases change people's lives. So, I want you to keep that in mind, as frustrating as these can get, that at the end of the day, this is a really valuable service. And, I know Zara and Maria and everybody at VLP are grateful for you being here and, trying to take on, get involved and take on these cases, because it's great work and it's rewarding work. And, I know Mike and I and there's other attorneys here, we all, are very, very happy to do it. So we have a few minutes left for any questions, I think.
Yeah, and in the meantime, I'll just remind everybody to please fill out the evaluation form, which should hopefully pop up when you exit the Zoom today, and also to fill in those 2 codes that were provided onto the affirmation that was emailed. You can do, it's a fill-in form, so you can type right on it, save it, and submit it to me by email so that we can get you your CLE certificate. I also want to thank Derek and Mike so much for presenting for us today. We miss you, Derek, but we're so grateful for all you still do and everyone at your firm for VLP clients. We really, really appreciate it. Zara, any closing remarks?
I actually also just wanted to chime in again and say thank you so much to Derek and Michael for a phenomenal presentation. Everything was very thorough, and especially I really appreciated the access to justice. And I think you really honed in on a lot of the issues that are specific to our clients. And I can say without any reservation that we get great client feedback, and I know that it can be very difficult at times, but that feeling of relief that our clients receive really just motivates them as well moving forward to stay on top of things. And it almost feels like I don't want to say they're like born again, but I mean it really is a fresh start, and it means so much to them beyond the interaction that we have with them. So thank you so much for your work on behalf of our clients, and a phenomenal presentation.
Sure. And if people have any other questions or if something comes up, I certainly would encourage you through the process of representing people to be in touch with Zara. Sure, especially if you're not sure how something is supposed to happen, and very often client, little issues will come up with clients, whether they're case-based or client-based. VLP and the tax clinic are, they're not only are they there to send you the cases and provide you the CLE, but to monitor the cases and provide that resource for you. And I know I left the tax clinic about a year ago now, but I'm happy that it's in Zara's hands, and I'm happy that everybody was here to listen and learn a bit. So thank you all for attending.
Awesome. Thank you, everybody. Have a good rest of your day.
Thank you.
Thanks, Maria.
Thanks.